I was reading about real estate. And I'm reading that in the big spike of activity we had in real estate, the average real estate agent that had less than 2 years of experience. So in other words, all the people that saw the real estate gold rush happening at the beginning of 2021, 2 years ago, because right now we're sitting here second quarter, May 1st of 2023. So those 2 years, everybody thought it was a gold rush. Boy, look what's going on in real estate. Gonna go get my real estate license. Well, I lived in Southern California, and I was just talking with Patrick about this. But we remember 05, 06, 07 in Southern California, where everybody, the joke was, they left Home Depot and Walmart and they went out and got their real estate license. And things were so easy in California that tree stumps got real estate licenses. So you had tree stumps acting as realtors. You see my point here is like everybody was in there. Home prices were going crazy. At any given time, there was like a 20% inventory rate. So 1 in 5 houses was on the market. Prices were going up. They were trading back and forth. They were doing a thing called range pricing. Like you can offer anything for this house between $500,000 and $520,000. That was a range for the asking price because they kept thinking that in another 2 months, that house is going to go for $520,000. So you have all these real estate agents going out. So we also had, from 2021 to 2023, a small pop that looked like that. By the way, in 2008, guess what happened to all those realtors that I was talking about? They went back to Walmart, they went back to Home Depot, and the long-term career realtors that had established networks and communities out there, they did fine. It may have been rough in 08 and 09, waiting for the market to come back, but they had a clientele, they still had clientele. They knew a neighborhood, they still knew the neighborhood. And all the ones that jumped into the pool got squeezed right out. Well, right now you've got a tremendous amount of people that jumped in to real estate right in the middle of this little mini gold rush we had. And would you like to know, Kellyanne, take a guess. You know what they earned in those 2 years? These are the real estate agents with less than 2 years of experience from 2021, 2023, the 2 years ending just a quarter ago. You know what their average was?
I'm not sure.
$8,800 a year.
That's it?
$8,800. I can't even say $9,000. There's not enough in there. If it was $8,900, I could round it up and say $9,000. I can't even do that.
That's nothing.
That's nothing. So the answer was they all got, real estate is crazy, and they all jumped in the pool, and then the party stopped.
Wow.
The party stopped. Everybody found out it's not so easy to do that. So let's go take a look at what's going on here. The first thing I want to go on is take a look at, let's go to the interest rates. Because we're talking a lot about interest rates. Everybody's waiting for the Fed right now. So let's go take a look. All right, and give me the thumbs up when everybody can see this chart. Okay, bingo, fantastic. So here is a chart showing interest rates since Q1 of 2020, and the gray bar on the far left represents a recession that happened there. Recession, beginning of 2020, so 3 years ago. And at that time, the blue line represents a 30-year fixed rate mortgage. That's what 30Y FRM means, the blue line. And then a 15-year fixed rate mortgage, 15Y FRM, represented by the green line. These are mortgages you and I would go out and get. You go to your bank, you go to B of A, said, hey, I'd like to get a mortgage. Me and my spouse, my partner, whatever you got going on there, you know, we make about $140 a year between our incomes, our credit is like 750. So good, not 800, but we're not 650. We're right there, solid, really solid. You would be looking at these interest rates right here. So as you saw, if you went there at the beginning of 2020, right after the recession, your fixed rate mortgage for a 30 was running about 3%, 3.5%, and then it would drop down and be under 3% all the way to January of 22. The 15-year mortgage, about 0.5% less than that. You were already under 3%, and you got as low as 2.5%, 2.25%. through 21, and then something happened in January of 22. You see things start to go up. And between January of 22, right around 3%, and November of 22, so just 5 months ago, more than doubling of the rates. So you see what the rates did during the year, and wrong. You see what's going, here they go, and they're going up, 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 up. Well, what did that do? Well, you would say, well, that just makes mortgages more expensive. Well, a couple other things happen in that. And by the way, the mortgages are still kind of flat hanging out right now. So your good credit, 700, 750 credit, 30-year mortgage right now, I looked the numbers up this morning, 6.25 to 6.5. And if you pay a point or you pay some fees, you can be on the lower end of that range. And then the 15-year is about 0.5% below that. Like you may find 5.5s to 5.75, and that's for your 15. Those are standard mortgages, nothing fancy, no adjustable rates. Don't pay 2 points to artificially bring the rate down. You're just trying to get a good mortgage without paying a lot of fees except the normal things on your mortgage. And that's where you are right now. And so they're flattening, and we're expecting Jerome Powell, and I'll talk about this more in a minute, to add about 1/4 point right now to the federal interest rate that we've got going out there, prime rate. So what does this do? Well, what this does is, what if your parents are living in, pick a city in New Jersey, right? Elizabethtown, New Jersey.
That's where I'm from.
And they're going to sell their house. And they tell you, hey, we're going to come down to Jupiter, Florida and retire. And we're going to sell our house. Oh, Mom, Dad, that's great. And they're like, but we only owe about $100,000 left on it. And we got like this 3% mortgage. If we sell that and we get $100,000 down there, it's like a 6.5% mortgage. We're going to pay more on that. And we just took a look. Man, the prices of houses are way up. So we were thinking we were going to sell in Elizabethtown for about $500,000 and buy something for $250,000 to $300,000. Nice townhouse, few blocks from the beach, beautiful Jupiter to Cuesta area. We're going to do that. Now we're finding out that townhouse is going to be like $550,000, like within $100,000 of our house here, and we're trying to downsize, and our monthly payment's actually going to go up a bit if we get the same $100,000 mortgage. You know what? We're not going to put the house on the market. We're going to stay put and see how this shakes out. Guess what? A bunch of people did what they did. Now, there are people that got displaced for work, getting layoffs, and 900 people a month are moving to Florida, and I think it's 450 a month or something. You can check me on that. They're actually moving to Texas. No state income tax, a lot of jobs and opportunities, and they've been displaced, or they're coming from a high taxation state like California, New York, Illinois. There's a whole thing coming. But the point is, why is the home inventory staying low? Because with the interest rates high, people, a lot of people, even though there's some that are layoff that are moving to Florida, 900 a day, are moving to Texas, 450 a day. Other people are like, you know what, I'm not going to sell my house, because if I'm downsizing, I got problems. Houses are way up in price in Florida, way up in price in many parts of Texas. I don't know. I don't know if this is the right time to do it. So guess what? Inventory gets stuck. And let's go take a look graphically what that inventory looks like. So pop me up the inventory chart. I need the blue bars. Okay. Take a look at this. This tells you, like you see those numbers, 1210, 1310, 1260, those are in millions. So that's 1.3 million homes for sale. So as you could see, back in 2020, there was 1.5 million homes for sale, 1.5 million in 2020. And then you see a couple times it pops down, and then look at it. Now you have a problem. Right now there's only 1 million houses for sale. Actually, there's less than 1 million houses for sale right now. So there is 33% less homes for sale than there were in July of 2020. And you see it's been dropping. There were two almost identical peaks in the middle of 21 and the middle of 22. So what's going on? That's the inventory. So there's not inventory. So guess what? If inventory stays low, even though interest rates are high, prices are staying high in places like Florida and certain parts of Texas, Tennessee. The prices aren't budging. So the homes that are out there for sale, there's no pressure to make them go down. There's not a competitive market of inventory. There you have it. That is why there's very few transactions happening. If there's few houses for sale, then there's fewer houses sold and fewer transactions and fewer new mortgages. Mortgages are down still at least 75% region by region in the US over the last year. And so that's what's happening. Okay, Tom, you always sound like such a bear. I'm not a bear, I'm actually a bull. But I'm really kind of impassioned about the numbers that I see and getting away from the spin we see on TV and talking about the numbers and the reality and what they mean and what you and I can do, whether we're getting ready to move across the USA or we're trying to run a business, and this represents a piece of commercial property we're buying, because the same rules apply for commercial property, even though there's other forces happening on commercial property. If you've got warehouse space, you're doing well. You're going to be able to sell it. If you've got office space, you're sweating. I'm going to talk about that in a minute. So here you have what's going on. So what do people see? Well, here's what I see. I'm calling it. The Biz Doc is calling it right now. I'm calling the bottom of the bad statistical time for housing. In other words, I think Jerome Powell's raising a 1/4 point this week, and I think with that 1/4 point raise is going to represent the peak of interest rates for housing. Now, I know housing interest rates, some of you are very technical and it's tied to other bonds and things like that. I get it. I get it. There's other forces. But I think this is going to be the last interest rate raise, and then he's going to go flat for a while. And then the Fed gets together every 6 weeks. So I think he's getting together June 15th, 16th time frame and the end of July. I don't think rates will be raised at those two. And by the time we get into early September, because July in 6 weeks takes you, I believe, right to Labor Day, I believe we might hear the Fed talking about dropping rates a 1/4 point, not at the September meeting, but after it. So I'm calling bottom on, I think we're at the peak of what we're going to see interest rates. I'm also calling bottom of, I see a cooling in the home prices. And a lot of the big banks that I was reading, their opinions, they see it too. They're projecting that we are going to have a mild recession, maybe 3rd quarter, 4th quarter, or 4th quarter, 1st quarter. And with that mild recession, that will be a little signal to the Fed that we need to loosen up. And then he gives maybe a 1/4 point back. That's why I believe that the interest rates you're seeing on mortgage rates and the associated bonds that cover those, I think we're seeing the peak of the bad news. We're slowly going to see toward the end of the year is that coming down. And I believe you're going to see a little bit of a loosening up in housing supply going into 3rd quarter, because I think people are going to, that need to move homes, are going to put a little more inventory out there. And with the recession coming, they're going to be worried that there's fewer people capable of buying them. Because in a recession, you know, you get a little bit of wage stagnation and other things go with it. So I'm calling bottom. So for the record, the Biz Doc, May 1st, I'm calling bottom on some of the bad stats. I think housing is going to start cooling in certain markets. Maybe Miami won't, but I think generally across the USA, you're going to see a cooling of about 5% of housing prices in 3rd quarter through the end of the year. That's when you're going to see it happen. And I think that the interest rates we're seeing now on homes probably as high as we're going to see them. And with what the Fed does, even though I expect them to raise a rate right now, a 1/4 point, I think we're going to see interest rates toward the end of the year cooling. Those two things with the recession comes together. I think housing is going to start getting better. In other words, more on the market, less unfettered, pricing growth, and a little bit more affordable mortgages, all going into Q4. So I think October, November is where we're really going to see that. So if you were thinking of a house, I might look in October, November for signs that your market might start to show you opportunities here. But remember, be careful buying on peak and never buy the most expensive house on your block. Let somebody else have that wonderful honor of being the most expensive house on the block.